Good day, fellow investors. Just a quick comment on what's going on with Europe with lowering rates, and rates are expected to continue to be lowered. And the key things here to discuss is that we are paying for those lower rates. Don't worry, there is always someone paying for it, and we are poorer in Europe day by day. Inflation might not be as stated, and you'll see some numbers later that just show how things are. This is the summary from Bloomberg. Cutting rates, not more debt restrictive, even if I don't see restrictive at 3%. The direction is very clear, so lower and lower rates. More optimistic on inflation, a little bit more pessimistic on economic growth, and the target is for inflation at 2%, and they have lowered just a little bit their growth, the GDP growth for the next year, even if things are expected to get better somehow in Europe, maybe on lower and lower rates. But they say that the conventional wisdom around the table is that probably long-term rates will be a little bit higher than those were before. Keep in mind those were 0. Maybe they will be now to 0.5, but still we'll see in future. The key is that rates have to be at 0 because the whole continent is full of debt and everyone is running these deficits. So there is, for Italy, for example, 1% in growth debt to GDP expected year by year going forward. They're running 4% deficits and they have 1% economic growth, which should then increase debt to GDP by 3%. But we have to add up inflation of 2% per year, and that is then limiting the ballooning of debt to GDP. So inflation there, low interest rates, and things can go on as planned. However, this is the problem. When rates were 0, governments could borrow at very, very low rates. 10-year Italy bond below 2%. It was even below 1%. Now at 4, going to 5, now ECB had to lower rates to cut inflation, which was not a European problem, was a global problem. But they think they did cut inflation, but okay, that's a different story. They have to lower rates because also the economies are based on low rates. If we just look at Volkswagen Group, if we just look at their balance sheet, look at the financial liabilities there. When you look at the total equity of 192 billion euros, look at the financial liabilities, non-current and current liabilities, financial liabilities, because Volkswagen needs to borrow money to sell cars. It's a big difference if you can get a car at 0% or at 7%. That's why the EU needs 0 interest rates practically. Businesses, governments, all the same pile there. And who's paying for that? Well, we are paying for that. If I look at my Dutch pension fund, the top largest investments there, the top investments are, of course, fixed income, and only the 8th investment is a business. And that business is also extremely expensive now. But okay, everything is in fixed income, and Apple has the same weight as the treasuries of the Kingdom of Spain. France, 23, I think it's billion euros. So huge, huge investments into fixed income. Then if I go lower there, mostly just fixed income. So they have 40% of investments of the portfolio in government bonds, and then 60%, likely another 20% in corporate bonds, and maybe 40% in businesses that are also expensive. But 60% or 40% of a pension fund in fixed income means that this is the value that those fixed income investments are providing, because the real return on those is 0. So actually you are losing money on those, and you are financing all those guys borrowing money and doing crazy stuff with it. So there is always someone paying. That's the key to understand. And we are getting poorer day by day because of that. And perhaps the most illustrative chart there is the following one. If you look at gross domestic product, France, Italy, Spain, in US dollars, which is the global reserve currency, that's the currency you measure things in. Look at their GDP. The GDP of France didn't go anywhere. Italy went down, and Spain also didn't go anywhere since 2008. That's 15, 16 years of zero. And people talk about economic growth, people talk about this, people talk about that, but this is reality. This is how free countries got poorer in this environment, because there was inflation also in the US. So also in the US dollar measurements in real purchasing power, we got poorer and poorer. Germany a little bit better, but still not spectacular. And on top of everything, I didn't find, because likely there is little research on it, but found something how the ECB is using a misguided inflation measure. And if you look around, the ECB says inflation is low, inflation is low. If you look around in Europe, you see inflation, 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 because if you go to take a leak in Germany, it used to be 50 cents, now it's a euro. So that's 100% inflation in 7 years. So the ECB might be wrong, and the Allianz research here shows how, apart from toilets in Germany, housing costs are not included, because everything you need to pay there is usually measured globally in US dollars, of course. There is also this article, The Fairy Tale of Low Inflation in the Euro area. There is really something behind it, and United States have it clear, the shadow stats, how inflation is usually 2 percentage points higher than what is shown by governments, and governments want to show you low inflation, so everything can be then based off lower inflation, lower interest rates, and everything looks better. Here you can see the discrepancy in measurement styles of inflation in the United States. But the key is, with all this money printing, with low interest rates, that the poorer are getting poorer and the richer are getting richer. This is the Italian income share of the bottom 50%. Look how it goes down. This is 50% of people. So this is something that is extremely important, but why not borrow more, borrow more? So highly indebted countries borrowed much more, relative stability here, and also very low borrowing for some countries. The conclusion is that the ECB, politicians, and everyone have a myopic view. That's also what customers, voters want. So nobody cares, or at least just a few care. Borrow, pay, and hope it gets better, or that you will not be around when something hits the fan. When things get ugly, well, unfortunately, it will be the end of the monetary union, because you cannot have these discrepancies in a monetary union. Interest rates here should be 7%, here 3%, and here 2%. That is economic law, and somebody is paying for interest rates that should be 7 to be at 3. Be it your pension fund, be it the EU government or something like that. And things like this are unsustainable for the long term, but as I said, nobody cares. What to do? Build your own wealth globally, and that's about it.